Maybe at this point we should insert something here about cash and CDs because, let's face it, it's been a rough 24 months. People are nervous, and so people are jumping into CDs because, quote, they're risk-free, end quote. But if they're only getting 1 or 2%, and the dollar is devaluing by 7 to 8% a year, this would seem to be a road to poverty because your ownings just dissolve right in front of your eyes as you watch them.
Yeah, I mean, even if you look at the pullback that we've seen in housing prices, that we've seen in even manufactured goods, or the general level of inflation, John, take a look at anything that you're buying today. I mean, if you were to buy a car today, you recently bought a car. Was it cheaper than it was 10 years ago?
No, it's gone up much more than since I bought my last car 5 years ago. Same model of car, just 5 years later.
Yeah, I have a friend who spent some time overseas. He's a missionary, and he was stationed in Romania. He was, and maybe I've told this story, but it really expresses it. He was at my house recently, and we were listening to, this is when we were doing the inflation-deflation debate, and he was listening to the Prechter interview. And all he did is he said, I don't know what that guy's talking about. Because when I left for Romania 5 years ago, the things I could do, I could buy for $20. Now that I've come back, it takes $50 to buy the same stuff I was buying 5 years ago for $20. And he was talking about the value of the dollar overseas, where he had seen in that period of time the dollar lose a lot of its value. And you can see that if you look at a chart of the dollar, where it hit like 121 on the international exchange value, and today it's at close to 75. A lot of people say, well, if I'm in the bank, I'm guaranteed. That is true. But understand that what guarantees your deposit is the Fed's ability to print money and inject money into that system. Because if you look at a lot of the loans on the books of these banks, if you take a look at a lot of the investments on the books of these banks, if we had to go to true mark-to-market accounting, these banks would be insolvent. And so that's one of the reasons they suspended 157, and what they're going to do is allow what they did in the S&L crisis, a carry trade where the banks can borrow at 0.25% from the Fed and then turn around and invest it in treasuries at, let's say, 10-year notes paying 3.4%. Well, if you're borrowing at 0.25%, this is what's allowing the banks to return to profitability. But people think if they have their money in cash that there's no risk there. You've got inflationary risk and you've got devaluation risk. And, John, let's play that clip of George Soros talking about the flight from currencies and also the revaluation of the dollar against the Chinese currency. That's going to trigger another round of an inflationary wave into this country.
Paraphrasing Churchill, the dollar is the weakest currency in the world except all the others. In other words, there's a problem with currencies, and I think there's a flight from currencies because of that. I mean, the dollar is obviously ought to be falling in value in order to allow the U.S. to adjust its current account. But it can't because the renminbi is tied to the dollar, and the renminbi today is a very important currency. So the dollar depreciates against the euro, against the real, against Australia, etc. It's an extremely crowded trade, of course. And these things are a bit overextended, and there are limits to what can be done. So I think there's a general flight from currencies. There are not enough assets that qualify for central bank holdings. That's why you have had the creation of sovereign wealth funds, and I think there'll be an increasing desire to diversify those assets from U.S. government bills and bonds into real assets.
So there you have, John, talking about the depreciation of currencies. In the next inflationary wave that is going to hit the U.S. shores is going to be triggered by revaluation of the Chinese currency. In other words, with China's money supply growing at over 28% a year, and when inflation starts to pick up in China, I do not think that they're going to this time raise interest rates and choke off their economy because of all the civil unrest. One way to combat inflation, which would be to let its currency rise, and as we've seen the correlation between a lower dollar and import prices, that could trigger the next round of inflation into the U.S., which will be triggered by revaluation of, let's say, the Chinese currency.
Yeah, what really factors in here, too, is the U.S. is in a horrible pickle right now. $75 trillion in both official debt and unfunded liabilities, and that's going up each year. At the rate Congress is pumping things through, no sign of stopping. Now, there is no level of taxation which is going to deal with this number. That's an impossible number. So the only way to hold off the dogs, so to speak, for a while is going to be to inflate the currency. And that's becoming clear to almost everyone.
It's coming clear to everyone. There's been a number of stories that have come out in the financial press, even though there's been denials. The Gulf states are meeting together to launch their own currency. You've got the BRIC countries that are meeting with the Gulf states. They're talking about eventually repricing oil out of the dollar into a basket of currencies. That's going to have another inflationary impact on the U.S. And so if you take a look at the trends in the investment marketplace, and what Soros was saying there is, what's China doing? It's exchanging its dollar reserves for tangible assets. It's buying commodities. It's buying energy, iron ore. It's buying copper. Soros made a reference there to sovereign wealth funds that are diversifying outside paper currencies because in one sense, there isn't a replacement for the dollar right now. And you heard Soros make a reference to that there's just not a lot of places, if you're a sovereign wealth fund, a country that's accumulating hundreds of billions of dollars of currency reserves, you don't want to be in the dollar, but you know what? The other currencies don't look that good either. So what they're doing is you're seeing sovereign wealth funds move into the area of tangible assets. Shrewd investors are doing the same thing. The unfortunate thing is that brief whiff of deflation that we experienced in the fall and winter of last year is now you've got investors doing just the opposite. It's almost like buying tech stocks in 1999. So they're rushing into bonds, they're rushing into cash, and investors are fearing deflation, when the symptoms of inflation are everywhere. Right now, that's one thing that the gold market is telling us. Rising stock prices are telling us. Rising bond yields are telling us. And so if you look at the market right now, we have rising stock prices, and we've had an uptick in the bond market here, which has been favorable, and the price of gold is rising. Well, out of those three trends, they all can't be true. One of them is an anomaly, and I would bet that the anomaly is interest rates, and you have a lot of deflationists out there saying, get out now, get out of stocks now. We're headed for a crash. Deflation's right around the corner. Get out of gold. Gold is going down to $6.50. Oil is going down to $10 a barrel. You know what? I just don't see it. I really don't see it. And the markets are telling us they disagree with that.
This is Mark from Texas. I believe that the Fed is concerned about the rise in gold, and I also would ask you, what do you think that they might do in response? What would the next move be that we could expect from the Fed, and when might that move be?
Mark, I think at this point they wouldn't mind a little rise in gold, because the one thing the Fed is fighting is deflation, so they want to see rising asset prices. I don't think they'd want to see the price of gold spike high, because then all of a sudden that would alert everybody to an inflationary whiff. One of the things they might do, which is something we only found out in the last 3 or 4 months how they did it, last year at this time, especially last summer when you had rising inflation, in fact, some of the highest inflation levels, and then all of a sudden, in the middle of July, you started to have asset prices get clobbered. And that was the Don Cox thesis, that this was being engineered by central banks. And what the Fed did, we can now look back in retrospect, is they did a $600 billion currency swap with foreign central banks. Those foreign central banks purchased U.S. securities. It put pressure on the dollar. The dollar rose tremendously in value. And as that happened, it caused commodity prices to fall, a wave of deleveraging. So if it got too high, they might be tempted once again to do a currency swap and try to artificially engineer a dollar rise.